All right, everyone. Hello, my name is Ryan Letourneau. I'm the co-founder and CEO at Grain. I'm excited today to be talking to you all about financing biochar projects in the new economy. I know on the schedule it says that we're going to talk for about an hour and 15 minutes today. That will not be the case. We're going to talk for about 30 minutes, and then I will have to, unfortunately, leave you all. I will be going to New York for investor meetings in advance of Climate Week, which is where us at Grain have really strived to put ourselves bringing the investor community into this space and trying to help project developers de-risk their projects to a level of investability. And so today what I want to talk specifically about is the mindset of investing, de-risking projects, the capital stack, what that looks like in practice, and what's changed since last year. You know, last year, even us at Grain, we came into this conference incredibly excited about the pre-purchase economy. You know, we saw everything that was happening in direct air capture on the carbon credit side, and we wanted to see more of that. Well, it's a new year, it's a new environment, there are other incentives associated with that, and just the mechanisms have evolved slightly in the way in which these projects are getting funded. Carbon is still an important part of that stack, but the way the agreements are being structured is different. But before we get into that part of the story, I want to focus first on why we're all here. And biochar is an amazing and an awesome thing. Everybody at this conference knows how many cool things we can do with the product. But at the end of the day, when we're talking about investability and the folks that are willing to participate in these projects, they see biochar as a solution for waste. And so we would be remiss to talk about biochar and financing biochar without first talking about the original source of that. And when I say waste, you know, we see it and we see value, which is different. So when we talk about the different waste streams that these projects can be structured around, we're talking about farms, we're talking about dairies, we're talking about feedlots, sawmills, wastewater treatment plants, and landfills. None of this is probably new to anyone in the room. However, the way that folks are thinking about what is being developed at these places is potentially different to the way that we've been talking the last couple of days. And just to give a few examples, I think dairies is one that we particularly have seen a lot, especially with the work that we've been doing in Indiana. These dairies are applying fertilizer or manure as fertilizer. There's becoming more and more awareness of the nitrates that are appearing in water, and communities are beginning to sue dairies. So what do the dairies have to do? They have to invest in expensive manure management projects. So as an outcome of that, it means that they have a waste problem. They're not looking at this as, oh, you know, it's new things, it's new revenue streams. It's, I need a solution to a problem that I have today. Even when we talk about sawmills and the opportunities that are there, as many of us have experienced, 20% of their revenue come from their offcuts and their sales to places like pulp mills. Pulp mills are closing in record numbers. So now that revenue becomes a cost. Wastewater treatment plants, historically there's been places you can land, apply those biosolids. There's become more and more awareness of PFAS, and the application to land is being outlawed. Now they have to ship it hundreds of miles away. And in every single one of these scenarios, these folks are having more and more costs. And they're looking for solutions to those waste streams and those costs, and they have to get a little bit creative. And luckily, that's where waste management, things like biochar, make a lot of sense. But how can they make sense when working with them? So as somebody that has waste, I have several options. I can consider doing compost, which historically has low cost, it improves soil health, which is a great benefit of biochar, but oftentimes it has a limited value in terms of the markets that are available. Anaerobic digestion, a good solution, but has energy and tipping, but high complexity. And then what do you do with the digestate? Incineration, you create some power, but limited carbon benefit. All that carbon is burned up, it goes up in the air, and which is a good use in some cases, but you don't have the climate impact that a lot of us are excited about. And so that brings us to biochar. And biochar is a clear winner when you're looking at the multi-product revenue streams of carbon removal. And so For biochar, you have 4 major revenue streams that are associated with it. And so the reason I want to talk about these revenue streams is because the revenue streams are how these projects pay back their capital stack. And so when we think of investment, it's not charity, it's someone giving you money so that they can get a return in the future. Even when we're talking about grants, those grants are given to you for a specific outcome. It's maybe not a monetary payback, but they're expecting a community benefit, whether it's in the form of jobs or in the form of avoided costs, maybe lower insurance risk, et cetera. And so when we look at the 4 major revenue streams associated with biochar, we have tipping fees, we have the biochar physical sales, we have the carbon credits, and we have energy. Now, tipping fees are, if you're not familiar with the term, are when you're paid to take the waste. This is not the same in every industry. Some industries are asking you to pay for that waste. That is, in fact, the case, depending on what type of waste you're managing. Biochar sales, $200 to $600 a ton. I'm talking about agriculture, landscaping, and remediation. I'm not necessarily talking about some of the applications that don't have the same carbon benefit. Because I've also got carbon credits as part of this revenue stack. 2 to 3 TCO2E, or corks if you're using the Puro methodology, at $100 to $200 a ton is what we're seeing. And then on the energy side, heat and power offsets, smaller scale. Sometimes this is combined heat and power. But the one thing that I want everyone to take away from this thought process here on the revenue side is that not all revenues are created equal. Oh, look at that. I anticipated the next slide. Not all revenues are created equal. And what I want to share with you today is just a high-level weighted impact structure that I've put together that helps me think through these projects when I'm helping a project developer analyze the potential opportunity that comes with the revenue streams of their project. And so what I've got here in the first column is the relative volume in units of biochar. So for tipping fees, this is feedstock, it takes, on average, 4 tons of feedstock for 1 ton of biochar. Quick math, 25% yield. And then when I think of the carbon credits, you're getting 2 carbon credits for 1 ton of biochar, 2 TCO2E per ton. And then on the energy side, what we generally see is when you're processing 4 tons of feedstock through a pyrolysis unit, you get about 2 kilowatt hours of energy. Well, each one of these has a different price. So if we're able to get $50 for a tipping fee, now the national average of tipping fees for landfills is $57. You know, $50 in some industries is a fair price. In fact, it was really interesting. There are folks walking around the conference today who are looking at this as a waste solution. When I asked them if they pay more than $57 today to manage their waste, they said yes. And some of this was actually in the wood space. So it's really interesting. It's really exciting. People are paying these kinds of fees. And it's a space that we like to pay special attention to. On the biochar, $240 a ton. I probably don't need to go too much into detail knowing the room here. On the carbon credit side, $150, and then on the energy, 16 cents. And national average is somewhere around 17 cents, but 16 cents is what we've gone with here. Then the third piece we're looking at is the cash flow timing. So if you're doing a biochar project and you're getting investment, you're building a business. And in business, cash is king. So in that case, cash flow is something super important to be considering. And when you think of cash flow timing, tipping fees, you get paid first. Oftentimes they'll pay you when you take the waste, before you've even processed it. So you've got money in the bank today for funding your processing that's happening tomorrow. Then you've got your biochar, often paid third in the list because you first have to process it. As part of that energy, which is part of the offtake story for power purchase agreements, or if you have on-site generation, that's paid second. And then fourth at delivery is the carbon credits. And this can take a long time or a shorter time, just depending on the methodology that's being supported. It could be monthly, it could be annually. But fundamentally, that carbon revenue usually comes in last. And so if we do a weighted impact, which is my formula of volume times price divided by timing, what we see is that tipping fees rule them all. It's almost a double weighted impact of the biochar sales. And so don't get me wrong, all of these things are important for different reasons, but tipping fees are the place that we all need to start when we're thinking about the kind of waste that we're going to be managing and the opportunities that we decide to go after if we're building a business and raising funds from investors. So outside of revenues, the next thing that investors are thinking about is risk. So revenue, consistency, and reliability is obviously one risk. But then when we start to think of the other risks that come up to for project developers to manage, feedstock uncertainty is of course one of the risks. Is your partner who's providing the feedstock going to remain solvent? Are they going to continue in operation? What is your alternative there? Do you have an ironclad agreement that is going to make it so that they will give you that feedstock if someone else comes along with a better price? Technology is another big one. Everyone needs to do their first installation. A lot of times those are pilots. We need to see them. But when we're raising funds and talking to investors, they want to see proven technology that is operating. They want to travel to a site. They want to touch the char. They want to see it working in real time. And then, of course, the carbon buyers, they want assurance of delivery. We've now seen in parallel carbon spaces, specifically in direct air capture, where there were a lot of promises made and then not delivered. So this year, something that has been hyper-focused on is the delivery of that carbon part of the story, and it's a big part of the agreements we see. So if you're going to get into a carbon commitment, what are you going to do to remediate any sort of difference between what you promised in your production and what's actually delivered? And then finally, just making sure you're timing your capital in the right structure. So trying to get carbon revenues before you've actually secured any sort of equity, it's a tough putt. We don't see it work out in the end, and it's a really important part of the story. So if we are talking about bankability, which is where this industry is moving, there are some key elements that you need to be focused on in building the bankability of your project. First is your long-term feedstock contracts with tipping fees if possible, but making sure there's an aligned incentive so they have to be saving money on their waste management on their side of the story. Proven pyrolysis technology and an OEM plan. So who are you working with? What are their installations? Where can you go and see it? Proven offtake agreements, so the char, the credits, ideally multi-year if you can get them. An MRV plan tied to the credit issuance so that if you are falling short or going to fall short, you have the right infrastructure in place. And that's something we at Grain have been heavily focused on this last year, especially with the commitments that are coming and the way that the contracts have been evolving on the carbon side. And then grants, USDA, SBA loans, ITC secured up front. The projects that move the fastest are the ones that get these grants we traditionally see. And so these grants take a long time. They have a long cycle, but when they're issued, they are great signal to the market, both for a carbon buyer, but as well as any other type of investor that's coming in, because the equity returns they're seeing, because there's non-dilutive capital in the stack, are exciting. And then finally, a sensitivity tested financial model. So what happens if you can't sell your char and you still need to get rid of your credits? What does your model look like? Is there still the opportunity to service your debt if you have bank loans or any other debt? Or what does that actually look like? And so these are the key items that we work with on project developers to make sure they have a project that works. And what we are particularly excited about is some of the evolutions we're seeing with the REAP program and the USDA loans, and the opportunity for capital. I think we saw over the last couple of months with the new administration change and some of the uncertainty around the IRA, a slowdown in the capital allocation structure. But now that things are a little bit more clear and there's some guidelines, let's say, in place that we can all get behind, things are starting to pick up again and the conversations are getting more serious. All right, the other exciting piece that I want to share today, and one of the new unlocks for this market, has been the ITC. So it's something that's been here. We're particularly talking about the 48E mechanism on the ITC side. If you haven't had the chance to visit all the booths, Electrotherm has been talking about this for a long time. So Natalie over there, spend some time with her. She'll tell you the soup and nuts of this. But fundamentally, the investment tax credits are 30% of the capital investment for the project if you're producing energy. Now, the reason this is interesting, and it's kind of a new unlock that was a little bit, let's say, under the radar, is when you actually do the math on the revenues associated with the electricity, as you saw on the table, it's number 4 in the stack. It is not super exciting. It's hard to underwrite when it comes to the capital investment in the full project. However, it does unlock upfront capital on the investment tax credit side, which is another piece of the puzzle that can be collateralized, can be used for tax equity investment, and just another piece that can help you bridge that finance, even if the revenues don't make your project pencil. So we're particularly excited about this, and it's just something new that's in the capital stack, and it's fundamentally begun to replace that carbon credit pre-sale story that we've seen. If we just talk through really quickly the levels of the capital stack that we're focused on, we see grants, and a lot of our projects get several of our projects have gotten the community and the forestry wood grant that has really given them a boost to get started on building their project. The USDA, REAP, and B&I programs, as well as SBA loans, have been a great lower cost of capital for folks that can qualify and get the appropriate agreements in place. Some junior debt and impact capital has been filling the gap, and then equity has been a smaller slice than before. And that's really how we see this market building up. And one thing I want to highlight is the carbon credit pre-sales in this space is fundamentally stopped from our perspective. Now, I say that knowing that we did a 100K pre-purchase just a couple of months ago, but going forward, everyone is focused on the forward commitment and being able to provide bankability terms for forward commitments on the carbon. It is really, my belief, unlikely that we will see millions of dollars in pre-purchases in this space based on what has happened in DAC and the kinds of conversations that are ongoing now within this space. And so that means we can be optimistic, we can come and we can talk about carbon credit pre-purchases, but we need to focus on forward commitments and things like ITCs that we can actually underwrite against and collateralize to get these projects funded. So what I want to do now is just to run through a few examples of financing in practice and how it's evolved slightly since last year. Some of the things have remained the same, but as I've alluded to, a couple of things have changed. So this is a scenario 1 example. This is an example of a company working to remove forestry byproducts. And so this group is working in alignment with the community to prevent forest fires. So just high-level numbers of someone that's trying to do this kind of project. They're paying $1 million for their pyrolysis equipment, $125,000 for construction expenses. Their operating expenses in their first year, things like feedstock, labor, maintenance, is $650,000. Their land insurance and carbon expense in year 1 is $225,000, so a total of $2 million. They are scrappy and are going to do it for $2 million. So if we look at the capital stack here, what they did first is they went out and they applied for the US Forestry Innovation Grant. And thanks to their initiative to work with the community to reduce wildfire risk, they were awarded it. And excitingly, they went out and decided they were going to get the matching funds to unlock that grant. So they worked with a small business administration, with a USDA bank, but did not go with the USDA loans. They instead went with an SBA loan, which is a collateralized loan, to unlock $800,000 and brought $200,000 in philanthropic capital as part of their equity financing. So there are groups out there that are investing in forest fire remediation activities for small equity slices, not necessarily because they're going to get a huge business return, but because it's important work. So this is one example that we're seeing work. It's a repeatable model, and it's something that folks are coming to us and looking to repeat on some of the smaller scale opportunities. The next piece of the story is the change from last year. And this project is slightly bigger in nature. We're still not at the scale of tens of millions of dollars in the types of projects that we're doing here in these examples. But the repeatable size of $2.2 million on a pyrolysis unit, $1 million in construction, $550K for operating expenses, and then $250 in the land insurance and carbon in year 1. So a $5 million project, put across the stack. So 3 million in USDA. USDA will sometimes do a 60-40 split on their debt, and that is what this opportunity does. What's unlocked here, and it's categorized as junior debt, which maybe isn't the right way to call it, but as a tax equity investment where somebody will underwrite the ITCs and get at a lower value of the 40% on that ITC at 1.5 million, and then an equity financing at 500K for private equity investment. And so because of the ITC collateralized opportunity, previously we were looking at carbon removal pre-purchase as a part of this stack with a smaller amount of junior debt. But in fact, that carbon removal pre-purchase either is not big enough or doesn't exist in the market that we're seeing going into 2026. So these are the kinds of models that we're working towards, and a lot of our project developers are finding their way. It's a mix. You don't have one person that invests in the whole thing. No bank does 100% debt. Your ITCs are only going to be up to 40%, and then you're going to take a haircut on them if you're selling them or using them as collateral. But fundamentally, there are different combinations of the capital stack that work. And this is really what we've been focused on, is building that community of investors and bringing them to the table so they can talk to projects who have a great opportunity. So I want to close today with just a call to action. So I know my presentation wasn't all roses and unicorns, but I would like you all to reflect on this and maybe change the mindset slightly of biochar is awesome. We all agree that's why we're here. But how do we think of it in a way that creates value within the chains of companies where they're avoiding a cost of waste or finding another way to create value? So remember that waste is your feedstock, and tipping fees make the rest a heck of a lot easier. So any chance you can work with tipping fees, it just simplifies the whole process. The carbon markets are rewarding biochar like no other CDR. 93% of the carbon credits last year were biochar. Now, those weren't pre-purchase agreements, but they were deliveries and purchases and forward commitments nonetheless. ITCs and grants are lowering the CapEx risk, and what we need as an industry is more bankable projects. So, myself, anyone that's around in the green jumpsuits here, Jason, Santiago, Alicia, who's downstairs, we love to talk about this stuff. We love to lean in and help you guys however we can, because what's good for everyone is more projects delivering biochar, more projects selling into new offtake markets, more carbon. It's what we need. So please design wise, build smart, operate at scale. Really excited to have the opportunity to share this with you all today. I know we've not taken the whole hour and 15 minutes, so if anyone, a lot of times when we do questions after a financing session, it tends to be hyper project specific, so we'll do a few questions. I ask that we keep it on the broader topic, and if you want to talk specifically about your project, happy to take 15 minutes. Santiago here will take your information, and we can jump on a call and talk specifically about the opportunity you guys have and get into the weeds. So thanks so much, and let's jump into questions.